Okay, hi everyone. Welcome to this MindBridge Edge session on what does medium risk mean. So today's session is really designed to talk about how does MindBridge present risk scoring. So we present risk scoring as high, medium, and low today. And what we wanted to do is to engage with you guys who have joined this session to explain how does it work today? What alternative approaches are there? And how do you use this information? So I'd like to take this opportunity to invite my co-presenters. So we have Nima Anvari, our lead data scientist at MindBridge. Nima's been with the company for a number of years and he works on our major data science projects. We also have Rob Peace, who's our product owner. Rob is actually also a data scientist and has been at MindBridge for, again, a number of years. His focus at the moment is looking at our product architecture and how do we construct the product to be the best it can be. I'm Rachel Kirkham. I'm our VP of AI and product. So I work with Rob and Nima very closely as we build the MindBridge of the future. So just to go through the agenda quickly, so we've got three key sections. So how does MindBridge score risk? So how do our control points work? How do we aggregate those together? How do we produce risk scores? We've then got a section looking at how do people use medium risk today and how can you control what's in the medium risk bucket? And then our third section is on different approaches to assigning these thresholds. So how do we, what's a different way we could look at high, medium, and low? So the first question we have for you is a poll. So the first poll we've got is, does your approach include a medium risk concept and outline what to do with those items? So if you're an auditor, you might have a particular audit response to the medium risk items you find in MindBridge. If you're an internal auditor, again, you might have a different audit approach depending upon how you like to do your internal audit work. And if you're operating an internal control, medium risk might have a particular response that you need to take. So I'm going to give you guys just a minute to respond to this poll. It should appear in your attendee hub, so you should be able to respond to the poll. Okay, great. Right, so we're going to move on to our first section. So the first section is how does MindBridge score risk? So without further ado, I'm going to hand over to Rob to walk you through how we do it today.
All right, hello. So as Rachel just mentioned, I'm going to talk about how MindBridge takes all of our control point scores, the millions of individual signals, and aggregates them into higher level actionable scores, including medium risk buckets. So if we could start with the next slide there. Yeah, so step one in this big process is just running the control points themselves. So and I'm going to be speaking mostly about GL here. But in GL, 30-some control points are run against the full data set, all entries in the GL. And some notes here. So some of the control points score individual entries, individual rows in the data, and some score transaction structures. Examples here, unusual amounts on the left scores individual rows. It looks at single dollar values in the ledger. Whereas on the right, we have unbalanced debits and credits. This looks at full transaction structures and determines whether the debits and credits balance out in that full transaction. Some control points produce continuous 0 to 100 scores. Again, looking at unusual amounts, you can have a dollar value that's a little bit or a lot unusual. So it scores between 0 and 100. And generally speaking, these tend to be the more advanced machine learning control points, while other control points are pass-fail. Again, looking at unbalanced debits and credits, either the credits and debits balance or they don't. So it's pass-fail. And finally, something, if you were watching Robin's presentation yesterday, you would have seen something about monetary flows. We do have special handling for control points that leverage monetary flow information, but that's outside of the scope of this particular talk. So we have run our 30-odd control points across the full ledger, produced, let's say millions of signals. And the next step in the process is applying these control points to all entries and all transactions. As I said earlier, some of the control points are entry level, some are transaction level, and we want to get all control points scoring all entries and all transactions. So how we do this When moving from the entry to the transaction, as we are on the left here with unusual amount, the transaction score is the highest of the entry scores. So this is, technically speaking, max pooling. Intuitively, you could think of this as a has-a relationship. If the transaction has an unusual amount, then the transaction is scored high for unusual amount. Going the other way, transaction level scores are broadcast to all the entries. So that one transaction level score becomes the score for all entries. Again, intuitively, you could think of this as a belongs to relationship. If an entry belongs to a transaction that has unbalanced debits and credits, that entry is scored high for unbalanced debits and credits. So after this step, all entries and all transactions have control point scores for them, which is useful in the next step, which is combining control points into risk scores. So the algorithm that we use here to produce risk scores out of control points is weighted averages. So each risk score is the weighted average of all of the control points that make up that risk score. So the individual control point values, the scores there, are multiplied by the weight that's provided by the ensemble. Those score by weight terms are summed together, divided by the total weight, you get the risk score. A few notes here. So the Mindbridge score that we see on the screen here is applied to all entries and all transactions. It's unique in this regard. Assertion and control custom risk scores are only applied to entries. And another note here, if you're looking to recreate this formula yourself to check out how we do it, pass-fail control points provide either 0 or 100 to the weighted average. So that unbalanced debits and credits, because that failed, that would provide a 100 into this equation. So at this point, we have control points and risk scores for all entries and all transactions. The next step in the process is aggregating these scores to segments. This is fairly straightforward. So unless specified, unless we say otherwise, if you see a score, a percent risk score or control point score for a segment in your data, that's an average of all the entry scores for that segment. So for example, looking at the risk by user ID scatter plot on the right here, you see Ronald Farnsworth has a Mindbridge score of 5.25%. Since we don't specify otherwise, that 5.25% is the average Mindbridge score for all entries posted by Ronald Farnsworth. And so this applies to both control point scores and risk scores that you might see in the product. And finally, the last step, once we have control point scores assigned to individual entries all the way up to some of the bigger segments in your data, we bucket these scores into high, medium, and low. So all 0 to 100 scores in Mindbridge are highlighted as being high, medium, or low. In some cases, even depending how you configure your tenant, and if you're interested in configuring your tenant this way, we can hide the individual percentage scores and only show the low, medium, and high signals, if that's how you wish to action our scores. Within GL, the default is that 0 up to but not including 30% is low, 30 to 50%, not including 50%, is medium, and anything 50% or higher is high risk. There are a few ways that we're playing around with this, that we're making bucketing more flexible. And these are actually going to come up later in the presentation, so stay tuned for that. And then one common way that we present aggregated risk information to you is as the number of entries and dollar value of entries in high, medium, and low buckets. So this is something, right, the first thing you see when you go to the risk overview. And these high, medium, and low risk buckets are based on entries values in those low, medium, and high risk buckets, the 0 to 30, 30 to 50, and 50 plus. So that's sort of a whirlwind tour of all the steps, all the steps going from individual control points up to the highest level, those 3 marquee buckets that you see on your risk overview, including that medium risk bucket, which we're going to ask a poll question about now.
Yeah, great. Thanks, Rob. So the next poll question is, when an item is deemed as medium risk, what actions do you usually take or would you expect to take? So the options we have here are I investigate some or all medium risk items and document as required. I ignore them. I'm uncertain about what to do with them. I ignore them because our methodology does not require us to address medium risk items. I don't know, and other. So I'm going to give you a minute or two to answer this question. Okay, great. So one of the things we wanted to talk about is to give you an example of how does one of our customers use medium risk today? So this is based on the Cherry Baccarat case study. This is available on our website if you're interested in reading the full case study. It's a really interesting document because it really talks about the methodology changes that they made in order to get some efficiency and really drive value from Mindbridge. I think it's a really good case study in how any audit firms could think about changing the methodology to kind of to optimize the approach that they're taking. So what do they do? So in a traditional sampling approach, we'd identify individually significant items. Those individually significant items are identified by applying materiality. So I'd say, okay, here's my material items, and then I'm going to sample the rest. So the presumed level of risk in that remaining population is a little bit higher, just because you don't really know what's in there, right? So the approach that Cherry Baccarat took was they were still identifying the individually significant items, so we're still taking the material items out, also taking out the high risk items because those are risky transactions, and so we're treating them in the same way we would an individually significant item. So we're then going to test the residual population. Because you've taken out the high risk transactions, the presumed level of risk in your residual population is lower, which means that you can reduce your sample size because you know the potential level of risk is lower. So it's a really interesting approach because it allows you can see the sample size in the traditional approach was 311 in this case example. And then with this, with the revised approach, taking into account Mindbridge's risk scoring, you're getting a sample size of 161. So that's a pretty big efficiency gain. What I really like about the paper is that it goes through the audit risk formula and how all of this ties together from kind of a first principles basis. So I would definitely recommend checking it out. But it's a really good example of how you can use the risk scoring to more effectively direct your testing. We've got another poll question. So the next poll question is, what is the most valuable method to document the high and/or medium items you choose not to investigate? So the first option is identify a group of entries below a risk threshold and investigate those above the threshold. Tag a group of entries that you determined a known risk and exclude them with an explanation. Enable me to annotate individual entries with explanations, or perhaps you're not sure about how you would document this in Mindbridge. We're going to give you guys another minute to just answer this question. Okay, great. So one of the capabilities that we added to Mindbridge in our main release was the ability to configure risk ranges. So it's worth noting at this point that this particular capability is tied to custom risk scoring. So this gives you the ability to both configure a new risk score based on the available control points that we have, but also apply that risk score to particular areas of your accounts. So for example, you might want to create a risk score that looks at revenue and therefore, limit your control point selection to a subset of control points that are tied to the risk you're looking to detect. And then you can go and investigate that in the risk segmentation dashboard and other parts of our product. Now, one of the things that we had feedback on is that in some cases, for example, with journal entry testing, it was actually valuable to be able to only really have two risk buckets shown. So in this case, you can remove medium risk entirely. You could also just use low and medium, or if you wanted to, or indeed high and medium, although can't think of a good use case for that. But you are able to remove the medium bucket. So one of the things that this could help with is if your approach is simply to direct people to test or not test something, so to test being red and to not test being green, this is a mechanism you can use to do this. So this is something that I think might have some practical applications in terms of operating internal controls through Mindbridge. So rather than having to work out what to do with your medium risk bucket, you could simply just set the threshold at which you want to test everything and configure that in the product. If you're interested in learning a bit more about how this works, I'd encourage you to reach out to your CSM. I'm more than happy to kind of walk through how you might apply this in practice. But it's just worth calling this out in case you were unaware we've released this capability. So next, we've got another poll question. So is there a context in which seeing medium risk results is important? So the answers you have here are no, to create a sample from different risk categories to make decisions about other low or high risk items, I don't know, or other. I'm going to give you just a minute to answer this question. Okay, great. All right, I'm going to hand over to Nima to talk about dynamic risk thresholds in Mindbridge.
Thanks, Rachel. Hi, everyone. Yeah, so I'll be talking about fixed versus dynamic risk. So if we go to the next slide. Right, so we've seen that the Mindbridge score is on a range of 0 to 100%, and that certain cutoff values or thresholds are used to determine the risk ranges. So as we've seen before, the default buckets are 30 and 50%, and so that determines the low, medium, and high risk bucket. I'll talk about a little bit about the advantages of fixed thresholds and when you might want to use dynamic versus fixed. And then I'll talk a little bit about our approach to dynamic thresholds in our flex analysis. So first of all, what's fixed? So when I say fixed, I mean like the default where we use 30 and 50, it means that they're determined beforehand, so they're preset. Whereas dynamic means that they're determined post-analysis, and they're based on the characteristics of the output distributions, usually by an algorithm. So first, why would you want to use fixed thresholds? Well, the first main reason is simplicity. So they're easy to implement. The simplicity, however, does come with the assumption that that the data environment in which they're used are relatively static. So they might be good for single use cases where the scoring and output distribution is well understood. Stability is another thing. So with fixed thresholds, it's easy to compare across data sets. So if you have a score that falls in a high risk bucket in one data set, that same score will fall in a high risk bucket in another data set because the values are predetermined. And the values being predetermined also means that usually there's some external input into what should constitute significant deviation to justify the assigned risk label. So a good example might be expert systems, where both the score and the mechanism that triggers it has some subject matter expert input into it. However, in the absence of having external input into this, or if you expect large variation in the scoring mechanisms, then there's a need to have a more data-driven approach so that the thresholds adapt to the changing characteristics of the data, and that's where dynamic thresholds comes in. Yeah, so if we go to the next slide. So yeah, so the main advantage of dynamic thresholds are exactly that they adapt to the changing characteristics of the data. That in turn makes them flexible so that you can use them across multiple use cases. And there's no need for an external input or judgment into what should constitute significant risk, because it's all relative to the output distribution itself. And so if we go to the next section. Yeah, so in the next few slides, I'm going to talk a bit about our approach to dynamic thresholds and how we approach it. But in order to do that, I need to say a word about standard deviation. So some or maybe all of you will know what this is, but for completeness, I'll just give a quick refresher on this. So everybody will know what a bell curve is. So on the right plot there, we have two bell curves. They're both centered at 0. So these are two bell curves with the same population average. But they differ in how the data is dispersed around the average. And standard deviation is a way of quantifying how data is varies around the population average. So if you have low dispersion, that means you have less variation around the average. And so data is concentrated near the center. And that's what gives the thinner bell curve in the middle in red. On the other hand, if you have high dispersion, then you have more variation around the average. So you see more variance and you get this sort of wider bell curve in blue. So for normal or for bell-shaped distributions, as soon as you know what the population average is and what the variation or the standard deviation is around that average, that completely characterizes a bell-shaped distribution. And so you can extract a lot of information out of it. And so this is sometimes used as a guidance on or motivation on building dynamic thresholds. So on the next slide, we have a typical normal distribution. And if we ask what percentage of the population lies within one standard deviation, that turns out to be 68%. So a large portion of the data already lies within one standard deviation from the population average. And if we ask what lies above one standard deviation, but less than 3 standard deviations, that turns out to be 15%. It's symmetric on both sides. So together they contribute 30 additional percent. So together with the bulk in the middle, that already covers more than 99% of the data. So more than 99% of the data is within 3 standard deviations. And then a very small percentage lies outside 3 standard deviations. So this is sometimes used as motivation of building dynamic thresholds by turning these into risk buckets. So what's in the middle would be low. And so anything within 1 standard deviation is low. Anything between 1 and 3 standard deviations would be medium. And then anything above 3 standard deviations is on the extreme tail end of the distribution, and that would fall in a high risk bucket. So this is good motivation. The only issue is that not every distribution is normally distributed. And so that's where another mechanism is needed. So for every distribution, you can talk about its average, what the population average is, and you can talk about what the variation around that average is, so the standard deviation. But not every distribution is normal. And particularly in the context of outlier detection, anomaly detection, the output scores typically look like this, where they're heavily skewed to one side. And this is kind of expected because outlier detection is trying to determine what the normal part of the data is and then where the outliers are. But it's not a 0-1 classification. There's some grading between them. But still, you can talk about what percentage of the data lies within 1 standard deviation of the population average. And that's still a pretty good approximation for determining normal in the data. But 3 standard deviations is no longer good enough because the data is so heavily skewed, and so it doesn't quite capture what you want. So you need some other mechanism to try to determine where the extreme end of the distribution is. So we looked at combining 3 different measures. So one is a percentage or percentile measure, because you still expect a very small proportion of the data to be on the extreme end of the distribution. But you're also interested in how that data is distributed in the tail end. So there's still a statistical measure involved. And you're also interested in distance measure, so distance to the maximum score, because not every intermediate value is actually realized. And so there may be some gaps in between. So you want to understand the distance to the maximum score as well. But what we found is that a combination of these measures gives a pretty good approximation for determining where the extreme tail end of the distribution is. And then in turn, we can turn that into risk buckets. So in this context, what's low? Low is anything within 1 standard deviation of the population average. And what's high? High is what's on the extreme tail end of the distribution. And what's medium interpolates between those 2 extremes. And we found that gives a pretty robust measure approach to dynamic risk buckets across a wide variety of data sets, in particular on payroll and vendor expense data and charge card, which we now have in our Flex analysis. So if we go to the next slide, I'll just end with one example to illustrate. So we have two histograms here. They're both the same distribution, so it's from the same score, except the vertical lines indicate where the thresholds are different. So on the left-hand side, we used 1 and 3 standard deviations for determining the risk buckets. And on the right, we used our approach to dynamic thresholds. And so if you look at on the left-hand side, it's hard to tell, but the vertical lines for 1 and 3 standard deviations are pretty close together. And that's because the data is so skewed to the right. And what ends up happening is that you flag 100,000 plus entries in the high risk bucket. And so that can be overwhelming if you have to investigate all of those. On the right-hand side, we identified where the extreme tail end of the distribution is, and that identifies about 38 entries. And then the medium cutoff is expanded so that you can account for the skewed nature of the distribution. So that's our approach to dynamic thresholds. I'd love to hear how other people work with fixed or dynamic thresholds. And I think we have one more poll question.
So yeah, that's right, Nima. So there's one last poll question. So how do you expect to know when to stop investigating items? So the system will clearly identify high-risk items and enable me to document that I've investigated all of them. The system will identify high-risk items and I'll use my judgment to determine how many items need to be investigated. The system will present items from different ranges of risk so I can decide which ones to analyze and investigate, or not sure. So that's the end of our presentation section. I'm just going to see if we've got any questions we want to ask. So the question from the audience is, which is better to use, dynamic or fixed thresholds? Nima, did you want to start for that?
Yeah, sure. I think it depends on the context. So if you're applying, if the scoring mechanism is based on an algorithm that you intend to use on a wide variety of data sets or use cases, or even if it's the same use case, but you expect to see large variance. So for example, if you're applying it on vendor expenses and you expect vendors to behave very differently across organizations, maybe, then using fixed thresholds might not capture that variance, and so you might want something more dynamic that can adjust to the changing circumstances.
Yeah, for sure. That's definitely a good answer. We just want to thank everyone for their time today. If you have any more questions, do feel free to reach out to us. We're more than happy to help. Okay, great. Thanks, everyone.